Okay, starting off now with the chapter 2. Let's get a quick understanding about the remaining aspects. First, we'll start with the two types of inflation and the methods of dealing in NPV. So let's look into these two topics on slide 11. So starting off, firstly, the two types of inflation and project appraisal. So let's get a good idea. So there are two types of inflation and project appraisal. First inflation is the specific inflation. Second is the general inflation. Specific inflation is basically different items have different inflation. Tomato is by different rate, potato different rate, apple different rate, banana different rate, different item, different inflation. General inflation is overall price. Overall, the economy has prices increased by 3% overall on an average. That is general inflation. There's an overall price rise in the whole economy, right? The overall price rise in the whole economy, that is general inflation. Overall price rise in the whole economy is a general inflation. Overall price rise in the whole economy is a general inflation. Specific inflation is different items have different inflation rates. Different items have different inflation rate. That's specific inflation. Overall price in the whole economy is a general inflation. So one is specific inflation, one is general inflation. Specific inflation is for specific item. General inflation is for the whole economy. Next, we have cash flow impact. How inflation hits the cash flows. So what happens in cash flow impact is your revenue and your costs are adjusted using specific inflation. So your revenue and your cost you should adjust using specific inflation, and you add the general inflation into the nominal discount rate. So in general inflation, your general inflation affects your discount rate. Your specific inflation affects your revenue and cost. So revenue and cost, you adjust the revenue and cost with a specific discount rate, a specific inflation rate, specific inflation, and your discount rate you adjust with the general inflation. The general inflation affects your discount rate. Specific inflation impacts your revenue and cost. So that is important to know that what affects what. Okay, accurate appraisal, correct inflation treatment provides more accurate valuation. If you do it correctly, if you consider inflation correctly, then you will see your investment appraisal will be more accurate, right? You will see your investment appraisal more accurate. Next, we'll look into methods of dealing with inflation in NPV. Methods of dealing with inflation in NPV. First, you look into real method. What about real method? In real method, you use real cash flows and you use real discount rate. In nominal method, you use nominal cash flows and you use nominal discount rate, right? In nominal method or money method, you use your inflated cash flows and your nominal discount rate, and in real method you use your real cash flow and the real discount rate. So money and nominal are interchangeably used. They're not separate terms. So money method or nominal method, you use your inflated cash flows and the nominal discount rate. In real, you use uninflated cash flows. So real cash flow is uninflated cash flows. Okay, real cash flows is uninflated. Okay, you use uninflated cash flows. You use uninflated cash flows and the real discount rate. Here you use the nominal cash flows and the nominal discount rate. Consistency, cash flows and discount rate must match. Always use real cash flows, real discount rate, nominal cash flows, nominal discount rates. So your cash flows and your discount rate should match. Next is consistency. Sorry. First, this is done. Next, there has to be inconsistency. Cash flow and discount rate must match. Nominal approach basically means best for tax and working capital. So whenever you have a tax and working capital in your sums, always try to go for nominal approach. Whenever you have tax and working capital in your sums, always go for nominal approach. Both methods produce the same NPV if applied correctly. If you applied correctly, you will ultimately realize that both the methods are producing the same NPV. Okay, so that is about the methods of dealing with inflation. So this is how you deal with inflation. This is how you deal with inflation, right? The general inflation you affect, the nominal inflation affects your cash flows like revenue and cost, and general inflation affects the discount rate. Real discount rate, you use real cash flows. If you're using nominal discount rates, use nominal cash flows. Nominal approach is best when tax and working capital adjustments are made, and if you use either of the methods, you'll realize you'll get the same NPV. Either of the methods, you will get the same NPV. Either of the methods, you will get the same NPV. Next, we'll look into the next set here is the impact of taxation on free cash flows. How does tax impact your free cash flows? Okay, how is tax impacting your free cash flows? So let's look into that. How is, tax impacting your free cash flows? Okay, the impact of tax on free cash flows. Firstly, operating tax, the corporation tax on profits under operating tax. Firstly, it's the corporation tax on profits. On profits, whatever profit you make, on that you have to pay a tax. That is corporating tax. Capital allowance is the tax depreciation allowed by the government. So tax capital allowance is just another word for the depreciation. So tax depreciation that is allowed by the government. So as we do the sums, we will see how it mathematically affects your calculation. So it's the tax depreciation allowed by the government. So in simple words, what is capital allowance? Tax depreciation allowed by the government, and it creates valuable tax savings. What it does, it will create valuable tax savings. Next, tax relief. The tax allowances lower the taxable profit, and that difference, how much it lowers, that is called tax relief. Your capital allowance, that is your tax version of depreciation, In accounting, we call it depreciation, and in as per tax authorities, right? Their version of depreciation is called as capital allowance. Their version of depreciation is called capital allowance. So if capital allowance brings some tax relief, capital allowance will bring some tax relief. It reduces your taxable profit. It reduces your tax overall. So that how much ever it saves, that is called tax relief. How much it saves, it's called tax relief. Next is debt interest. It interest gets tax relief. Debt interest is interest gets tax relief. What is debt interest? Interest gets tax relief. Your interest gets tax relief, right? So whenever you pay interest on your loan, because of that interest, you what happens is your taxable income reduces, and when your taxable income reduces, you're paying lower tax. So what is debt interest? Debt basically brings a tax shield. The interest that you pay on a loan, it is a tax shield. It reduces your tax, right? So interest always brings tax relief, and it lowers your financing cost. And debt interest, so debt the interest tax reliefs lowers your financing cost. So the tax relief lowers your financing cost. The tax relief lowers your financing cost. First of all, what is tax relief? And first of all, let's start with operating tax. The tax on your profits is called operating tax. What is capital allowance? It's the tax version of depreciation. The taxman's version. So tax rules are different in India. Accounting rules are different in across the world. Tax rules and accounting rules are different. They are two different functions. So the tax rules version of depreciation is called capital allowance. Capital allowance bring tax relief, right? And the tax relief on interest payments will reduce your financing cost. The tax relief on interest payments will reduce your financing cost. And then finally, after tax cash flow. So NPV should always be based on after tax cash flow. Whenever you're calculating NPV, always use after tax cash flow. Whenever calculating NPV, always go for after tax cash flows. Whenever calculating NPV, always go for after tax cash flows. Okay, whenever calculating NPV, it's always better to go for after tax cash flows. Whenever calculating NPV, always go for after tax cash flows. Whenever calculating NPV, always go for after tax cash flows. Very important. Next, we'll look into here is the internal rate of return and MIRR. So before we do this, we'll look into some sums here quickly. All right, perfect. Shri, can you see my screen again? Okay, looking into whatever we studied, we've looked into a calculation that will make complete sense as we've just looked into all the inflation and all the changes that happen here. Okay, so first we'll simplify the question here. Okay, so simplifying the question over here to test your understanding on what is really happening over here. That the question, a company wants to buy a new product for 5 years. So company basically plans. What is the company planning? The company is planning. Company plans to invest 7 million in new product. So how much is the investment? Initial investment is 7 million in a new product. How much are they investing? 7 million in a new product. So you see 7,000 coming here as an outflow. Okay, you see 7,000 coming here as an outflow. They're investing 7 million in new product. 7,000 is the outflow. Next, their net contribution is expected to be 4.2 million per year in real terms. That is without inflation. Okay, so your contribution is increasing by 8%. So just quickly do this, Shri. 4.2 into 1.08. 4.2 into 1.08. Okay. That into 1.08. Quickly. Quickly. 1.08. Okay, so you got the hang of it. So what we've done is 7 million. You see, this is an outflow because the company is investing. So if you see in a negative 7,000, next 4.2 in real terms. Real term means without inflation. So you inflate it and you put it over here. Why? Because the question has tax. So whenever they say the question has tax, it's always preferred and working capital. So here there's working capital for sure. And there's tax later on. Is there tax? No tax. Okay. So when there's working capital and tax, always is better to go for the nominal method that is with inflation. So firstly, you took your investment, you did that here, you put that 7,000 here, then you took your net cash, then you took your contribution, and then you inflated your contribution and you put that here. Marketing expenditure is 1.4 million. Next is your marketing expenditure. Marketing expenditure is 1.4 million. So we have a marketing expenditure of 1.4 million per year, which will also be needed, and marketing is inflating by 3%. So quickly, let's do this 1.4 into 1.03. Okay, so you got the hang of it. So this is how we'll get your marketing expenses then. So every year you have your marketing expenses for the next 5 years. Next, I think expenditure of 1.3 million will be required. So next is the expenditure of 1.3 million. Next is your 1.3 million expenditure. What about it? The expenditure of 1.3 million per year will be required to replace the existing machinery. Okay. And will grow at this. So how much you will spend? 1.3 you will be spending per year will be required to replace the existing asset, which will now be used on the project but are getting to the end of the useful life. The expenditure will be at the start of each year. So because they're saying start, so this is why you see 1,300 is our year without inflation because they're saying start. After that, you start inflating. So let's do this 1,300 into 1,352. Sorry, into 1.04. 1,300 into 1.04. Okay, so how you just understood why you take 1,300 in time zero because they say start of the year here. Okay, because they say start of the. Hmm. The default is at the end of the year unless otherwise stated. Default is end of the year. Okay. Additional investment in working capital is required 10% of the contribution. So whatever the contribution is, 10% of that will be your investment in working capital. Whatever the contribution is, 10% of that will be your investment in working capital. So this is your contribution. The 10% of that will be your investment in working capital. 10% of that. So if you see your contribution 4536, so you take 10% of this, you will need it at time zero. Now why they are selling again at the start of each year. So whatever 4536, take 10%. Okay. Next 4899, take 10% quickly. 489 minus that with 4536. Sorry, 4 from 489 minus 454. Yeah, okay, 36. Again, one more year. Do 10% of this, 5291. No, with what the second year was. Okay, so you see here 4536, you got 454. 4899, you got 490. 5 529. 5714, you got 571. 6161, you got 617. Okay, so now what you do is 454 you invest in the first year, and 490 minus 454 you get 36. 429 minus 490 you get 39. 571 minus 529 you get 42. 617 minus 470 you get 46, and then 56 in the last year positive 617. The last year 617 will come here. Why? Because they're saying capital will be released at the end of the project. Because they're saying this. If they're not said this, I wouldn't have done that. Okay, because they're saying the working capital will be released at the end of the project. So it will be released. So that's why this. In the first year 454, and then you have incremental all the years. Last year it will increase. That's it. Because you have to take only incremental cash flows. So how much increase you're taking, you have to just take that. So in this case, you're taking the incremental. So after doing all this, we got the net cash flows for all the years. And because we have taken the inflation, so we have to take a nominal discount rate. We cannot use a real discount rate. So here they have given us the general price increase. So general price increase is what gives we use in the discount rate. So we had studied this general price increase, we use it in the discount rate. So 4.7 and 6%. So you multiply the two and you get your nominal interest rate. right? So you use this formula and you will get your nominal interest rate. So nominal is equal to 1 plus inflation plus 1 plus real plus 1 plus inflation. So your real is 6% given 1.06. Your inflation is given 1.047. Multiply the two and you get your nominal rate. So your nominal rate is 11%. So use the discount rate at 11%. Use the discount rate at 11%. Okay, use the discount rate at 11%. So this is why, because you have inflated cash flow, so you have to use the inflated discount rate, and this is how you get the inflated discount rate. Okay, and once you got that, then you have the present value of all the cash flows. When you take the NPV plus 790, you add all the inflow, subtract from the outflow, you got 790 triple zero. That's it, done, finished. Okay, so that is all about this NPV with inflation. Okay, so this is with NPV with inflation. So an inflation is revised over here. So TYU1 is on this. Your NPV with inflation. So your TYU1 has come from here. TYU1. So whenever revising, revise this, immediately do off the. Okay, so that is your TYU1 here. Okay, so whenever you revise this, just go through TYU1, so your inflation is done. Next, we look into TYU2. We look into impact of taxation. The sum. Okay, illustration. Okay, so looking into TYU2 here. So we're looking into the second sum over here, getting a good understanding about this. So a project will require an investment of new asset of 10,000. So your investment in your project will be 10,000. So you have an outflow. You will put off 10,000 over here because it's an investment in the project. Now, okay, the company wants to buy a machine for 10,000. So 10,000 you have put here. And the project details are there. Life is 4 years. So you see pretty much 1, 2, 3, 4 will be used. They've used 5 because obviously maybe the tax would be paid in arrears. So ideally they say you take that and write one more always. So whenever you make the format, you tell the year, they tell 4, you make for 5. Might not be, but it's good to have 1 year extra in advance already because if they tell in arrears, you will need it. So they told 4 years, we've used 4 years here. They've told 4 years, we've used 4 years. They've told 4 years, we've used 5 years. Always 1 year ahead you take, always. So start at T0, go till T5. If they told 4 years, go till T5 always. After which it will be disposed of on the final day of year 4 at 2,500. This is your scrap value of 2,500. This is your scrap value of dollar 2,500 is your scrap value. What is your scrap value? 2,500 is your scrap value. You see there's an inflow of 2,500. Inflow of 2,500. Because scrap value is always an inflow. There's an inflow of 2,500. There's an inflow of 2,500. Next tax 30% paid 1 year in arrears. So your tax is always paid 1 year in arrears. That means you pay 1 year late. You have to pay at time one. First tax you should ideally pay at time one. Now you will pay it at 1 year later. Right? You start paying your tax at time two. Either you pay at the end of the year. So first year ends at time one. So you should pay your first tax year 1 year late means you start paying your tax over year. Right? So you're paying 30 years, 1 year in arrears. 30% 1 year in arrears. 30% 1 year in arrears. Just do this here quickly. 15 threes are 45. So 30% of this is this. Just do this 2125 into 0.3. 2125 into 0.3. Okay. So you're making sense of the numbers here. So this is your tax that has come here. Okay, so this is your tax that's come here. And tax allowable depreciation is 25%. So your tax allowable depreciation is 25%. This is the next thing here. This is your tax allowable depreciation. This is at 25%. So again, what you do is first you start the asset. Asset was 10,000. They have told us already asset was 10,000 over here. 25% is the depreciation. As per the tax rules, 25% the depreciation. So you reduce 25%, you get 7,500. How much do you get? 7,500. How much are you getting? 7,500. How much are you getting? 7,500. And then again, 25% of written down value because they're saying written down value. So the written not at 10,000, but the written down 7,500. You take 25%, reduce, you get 5,625. Again, you take 25%, reduce that, you get 4,219. Later on, you've sold it for 2,500. and you've got a loss of 1719. Okay, so this is all about your the tax allowable depreciation. This is all about your tax allowable depreciation. You see, you get your tax allowable depreciation. What you have done over here is that you've taken your tax allowable depreciation, and first from this, what you have done is you have added it over here. Tax allowable depreciation, just your depreciations. Okay, only in the last year you would see, only in the last year you will see, you will take the balancing allowance, the profit or loss. You don't do anything on the 2,500. You net the two and you take the difference. On the difference, you've made a loss, so you'll get a tax savings on this. If it was a profit, you'll have to pay tax, but here you made a loss. In your books, it was 4219, you sold it for 2.5, so you made a loss. So you first added all this. Okay, first what you've done is you've added all this over here. Sorry, you have subtracted all this over here, and then you have added all this over here. So first what you do is first you remove and then you add it back. First you have removed, then you have added the same amounts back. First let me just put the same color here. What you have done first is you have removed it, then you've added the same amount back. Right? So what you've done here, from your net trading inflows, first you subtracted your tax allowable depreciation, all is netted off. So you get your taxable profit, you've calculated the tax on the reduced amount, and then you add back your tax allowable depreciation. What you're doing is you're adding back your tax allowable depreciation. How do you get the amounts? First of all, initial investment was given. You take 25% of that, you get 2,500. That is your first year's 2,500 over here. Then you got the reduced value, again 25% of the same, 1875, you take it over here. You get 5625, again 25% of that, 1406, you take it here. 429, you would not take 25% because you sold it this year, you will take the loss. You sold it at a loss, 1719. So first you subtract it from your net trading cash flows. Right? It's netted from your net trading cash flows of 4,000 per year. Right? 4,000 per year, 4,000, 4,000, 4,000, 4,000. So this is how you get your 4,000s first. Net trading. So first they've given you the net trading. From the net trading, what you've done, you've subtracted the tax. From the net trading, what you've done is you have tax allowable depreciation. You subtracted the depreciation. From this, your tax allowable depreciation. So you got a taxable profit. On this, you've calculated the tax, but you've taken tax 1 year later. Once you've done that, then you've added back your tax allowable depreciation over here. You had your initial investment and your scrap proceeds, which you've already done. So you've got your free cash flows. Once you've got the free cash flows, discount factor is they've already given 10 and they're telling to ignore inflation. So you'll just take it as 10. So you've taken this at 10, you got the present value, you got the NPV. The only thing that's confusing, tax allowable depreciation, this is one way of doing it, that first you add it and then you subtract it. Okay, there's one more method which I will tell you as we go forward, just trying to stay with the question so that when you revise it, you feel relatable. So that the first one, 4,000 given. This one you calculated and you know exactly how to calculate, just tax allowable depreciation on the reducing balance. So at the reducing balance, you have to take the amount, and the reducing balance, you take the amount, and 25, the percentage stays the same. However, in the last year, you don't take this, you take it on the loss because you sold it at a loss over here. That is about this. You'll have to pay tax. Yeah, you'll have to pay tax. We'll get a sum like that only. So in case of profit, you'll have to pay tax. In case of loss, you will make tax savings. Here, they have not taken tax savings, but that is the kind of question that will come in the exam. So we will look into that. Here, just you developing an understanding about how to go about the numbers. So here, CC discount factor is clear to you. Scrap proceeds is clear. Investment is clear. Tax payable is clear. Net trading cash flow is given. Only tax allowable depreciation, that also you know how to calculate. Basically, you're just taking 25% of the carrying value, 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 25% of the carrying value. The last year, you just take the balancing allowance. First, you subtract it from the net cash flows, then you add it back. That is one way of doing it. There's another way of doing it, which I will just get to in a short bit. So this is how about you go about this particular calculation. Okay. Hope it's clear this. Okay. Did you get this here? It's clear, Shri? Okay. NPV calculation, yeah. Tax payable. Okay. It's the same, pretty much same thing. Okay, so TY1, TY2 is on these topics that we have just finished. So TY1 and 2 are done. Moving on now. General inflation, specific inflation, and TYU1 is on 2 on this, and TYU2 is on tax. Your TYU2 is on this. So whenever you revise, you know exactly which sum to look into when you're revising your theory. So study it, immediately look into that. Study this, immediately look into that. And that is about this. Next, we'll look into the internal rate of return. and the limitations of IRR and why MIRR is better. So let's quickly look into this here. So looking into internal rate of return, what is internal rate of return from the definition perspective? It is the discount rate where NPV is zero. Discount rate where NPV is zero is called internal rate of return. Discount rate where NPV is zero is called internal rate of return. Discount rate where RPV is zero is called internal rate of return. Next, what is the decision rule? The decision rule is except if IRR is greater than your cost of capital. If IRR is greater than the cost of capital, accept the project. If IRR is less than cost of a capital, don't accept the project. If IRR is greater than cost of a capital, accept the project. If IRR is less than cost of capital, don't accept the project. Next, how do we find IRR? Right? You use a method called as interpolation. Right? Use a method called as interpolation. So we look into that as we get to the numericals. You use a method of interpolation to calculate the IRR. So where you use a positive NPV and you need one positive NPV, you need one negative NPV, and then you're able to put it into the formula and you will get the IRR. You get a positive NPV, get a negative NPV, you put it in the formula and you get the IRR. You need a positive NPV, need a negative NPV, you put it in the formula and you get the IRR. Positive NPV, negative NPV, and you get the IRR. Okay, we'll get into that formula. Next, why do you use it? IRR measure the project's expected return, and if your return is greater than your cost of capital, then you can go for the project. If your return from the project is greater than the cost of capital, go for the project. So what is IRR again? Discounted at which NPV is zero. What is IRR? Discounted at which NPV is zero. What is the decision rule? If IRR is greater than your cost of capital, IRR is less than your cost of capital. Which formula uses interpolation? Project return. IRR measures the project's expected return. And investment decision, IRR supports the project acceptance or rejection. IRR supports a project acceptance and rejection. Okay, what is IRR definition? Is discounted which NPV equals zero. Decision rule accepts projects when IRR exceeds the cost of capital. Interpolation, IRR is estimated using interpolation between two NPVs. So we'll get one positive NPV, one negative NPV, and we will find the IRR. If your project return is greater than your cost of capital, then you can go for the project. If not, don't go for the project. Investment decision, IRR supports project acceptance or rejection, and you know the decision rule. If it helps you to decide whether you should go for a project or whether you should not go for a project. Next, limitations of IRR and why MIRR is better. So IRR is basically the limitation is there can be multiple IRRs. If cash flows goes positive, negative, positive, that's called unconventional cash flows or non-conventional cash flows. So generally conventional cash flow is first year is outflow, after that inflow. That's called conventional cash flows. But non-conventional cash flow is that first year there's outflow, then inflow, then again inflow, then again outflow, then inflow, again outflow, inflow, again outflow. So there's unconventional outflows, unconventional cash flows. So when they're non-conventional or unconventional cash flows, it produces multiple IRRs and then hence rendering IRR as not as useful. First reason. Second, ranking problems. IRR can't compare two projects properly if they are mutually exclusive. Mutually exclusive means they cannot be done together. If two projects are mutually exclusive, IRR is not as useful. If projects are mutually exclusive, then the IRR is not as useful. If projects are mutually exclusive, IRR is not as useful. Next, reinvestment assumption. IRR assumes you reinvested cash at IRR itself, which is unrealistic. IRR assumes that you reinvest cash at IRR itself. IRR assumes that you reinvest cash at IRR itself. What does IRR assume? The IRR assumes that you reinvest cash at IRR itself. What does IRR assume? The IRR assumes you reinvest cash at IRR itself. Right? IRR assumes that you reinvest cash at IRR itself, which is unrealistic. IRR assumes that you reinvest cash at IRR itself, which is unrealistic. Okay, the investment assumption is unrealistic over here. So MIR fixes the unrealistic reinvestment problem of IRR. So what MIRR does, it assumes that the reinvestment is at the cost of capital. So this one fundamental assumption is changed over here. They assume that the reinvestment is at cost of capital. MIRR assumes that the reinvestment is at the cost of capital. IRR assumes that the reinvestment is at the IRR itself. IRR assumes that the reinvestment is at the IRR itself. MIRR assumes that the reinvestment is at the cost of capital. The better measure, MIRR is always a more realistic measure of investment return. MIRR is more in a better measure of investment return. MIRR is a better measure of investment return. MIRR is a better measure of investment return. Then we'll look into MIRR in a little more detail, which is modified internal rate of return, which is just little modified. So let's look into that. Firstly, it takes all the cash flows to present value today. What it does, it takes the present value of outflows. It's calculated at the cost of capital. What do you mean by that? Okay. What do you mean by that? Discount cash flows. Uh, hello. Uh, किसकी? Uh, uh, okay. Okay, so we got the discount outflows. Firstly, discount outflows, present value of outflows is calculated at the cost of capital. Okay, firstly, discount outflows. The present value of outflows is calculated at the cost of capital. Present value of outflows is calculated at the cost of capital. So when you discount something, the present value of outflows, it is calculated at the cost of capital. When you take the present value of the outflows, it's calculated at the cost of capital. The discounting is done at the cost of capital. Right? The discounting is done, the discount outflows. They take all the cash outflows to present value today. You use cost of capital. Second, compound, you take all the cash inflows to fair value at the end. So what you do is you take the present value of outflows, calculate at the cost of capital. All the outflows you take it to the present value of all the outflows calculated using the cost of capital. That's the present value. That's today's value. Future value of inflows is calculated using the reinvestment rate. So this is the fundamental ideological difference. They say whenever you're discounting outflows and inflows, you use fundamentally two different rates, right? They're telling you use fundamentally two different rates, and that's the philosophy of modified internal rate of return. So when you're discounting your outflows, do it at the cost of capital. When if you're finding the future value of your inflows, use the reinvestment rate. So that is the philosophical difference between IRR, which just assumes reinvestment rate everywhere, whereas modified internal rate of return for outflows, it assumes cost of capital. Right, and future value of inflows, it says that you can do using reinvestment rate, but everything using reinvestment, they say it's not a very good idea. Right, then MIR formula is calculated using the terminal rate and the present value. So there's a certain formula that's calculated using the terminal value and the present value. You use the terminal value, use the present value, you'll get the MIRR. And then finally, conservative return. MIRR usually produce a lower but a more realistic return, and it is a more practical method. It uses a more fundamental and realistic return. It uses a more fundamental and a realistic return. Right, it uses a fundamental and a more realistic return. What it uses is a fundamental and a more realistic return. What it uses is a fundamental and a more realistic return. What it uses is a fundamental and a more realistic return. Okay, it uses a more fundamental and a realistic return. It uses a fundamental and a more realistic return. What it does, it uses a fundamental and a more realistic return. So first of all, IRR formula, I will just take all the formulas right here, so that as you revise, it just feels a lot more relatable, not just theory. So this is your, first of all, your IRR formula. We'll quickly get to IRR. This is your IRR formula. It was interpolation. So this is how you do it. When you say interpolation, this is the formula. Then we have the MIRR. This is how you calculate your MIRR. Is the formula for your MIRR. Okay, so let's look at a discounted payback after this. So we got IRR and then we MIRR. We understood that they have their own differences where they say different for outflow and inflow, which is not the case. The reinvestment formula is calculated using the terminal value and present value that you can see over here, right here. And finally, it's a conservative return. It will be lower, but it will give you a more realistic return. Practical method MIRR is preferred for investment decisions. MIRR usually is preferred for investment decisions. MIRR is preferred for investment decisions. Okay. When we talk about MIRR, it is preferred for investment decisions. When we talk about MIRR, it is preferred for investment decisions. Okay. MIRR is preferred for investment decisions. When we talk about MIRR, it is preferred from MIRR is preferred for investment decision. Okay, MIRR is preferred for investment decisions. So that is about this. Let's do a few sums and let's get done with this topic here quickly. Okay, so now let's look into the topics, the questions here for IRR and MIRR. Let's quickly get that done. First, we'll look if there's any questions on IRR. Yes, there is. So quickly, let's solve this. So here what they're telling you, there's an initial investment of 2000. So you see negative 2000 here. Initial investment of 2000, you see a negative 2000 here. And then project yields the cash flow of 500, 500, 500, 600, 600, 440. So you have your 500, 500, you have your 600, 600, and you have 440, 500, 500, 600, 600, and then you have your 440. That is your cash flows. So first you got the year 0, 1, 2, 3, 4, 5. Then you got the cash flow. Then first is negative, and then you have the positive cash flows. Then you have the present value factor, the present value at 12%. At 12%, you have the present value at 12%. You have the present value at 12%. Okay, you have the present value at 12%. So you take the present value factors throughout. You have the present value at 12%. So you take the present value factors throughout, and then you just take the discount factors. You got the present value of all, multiplying the two, you got the present value of all, and you got the NPV. That is negative 98. Right? The NPV you've got is negative 98. Okay, negative 98. Now what you do is you do the same thing. All the differences you take 8% here. Right? 12% was there. You take 8% here. Okay, so you just take a low. Now you see what the NPV is here. So if the NPV was negative, in whatever in the question, whatever was given, if the NPV was negative, then you take a lower number to get a positive NPV. If your NPV was positive over here, now you need a negative NPV. So you take a higher number to get a negative NPV. So you'll have to just accommodate based on seeing the 12%, because see, here 8% is nowhere given. That you have just done using your own point of view. So you have just done this using your own point of view. So 12% and 8%. So you have 12% and 8%. So 12% you have the factors, 8% you have the factors. 12% you have the factors, 8% you have the factors. Okay, 12% you have the factors, 8% you have the factors. Okay, 12% you have the factors, 8% you have the factors. 12% again, the discount factors 0.89, 797, 712, 636, 0.567. These are at 12%, and that 8% also, you know what it is. You can get it from the present value tables. So where is this? In the present value table, you can use these, get these factors. You have to just look for 8%, and year 1, year 2, year 3, year 4, year 5, 8%. Okay, so you did this, here you got 2 NPVs. Now you just apply it in the formula. This is the formula here. So in this 12 and 8, which is the lower rate, 8 is the lower rate. So you see, you start with 8. First you take the lower rate plus NPV of the lower rate. So of the lower rate, the NPV was 108. So you take 108 NPV of lower rate divided by NPV of lower minus higher. So you subtract the two NPVs here. So this basically becomes plus 98 into the difference of the higher and the lower rates. So 12 minus 8. So you got your IRR, which is 10.1%. So if the cost of capital is, if your IRR is greater than the cost of capital, only do this. But in this case, you see the cost of borrowing is 12% and your IRR is only 10.1. Okay, so you should be reject the project. As per IRR, you should reject the project. Okay, as per IRR, you should reject the project. So first you just calculated the NPV as they have directly given the cash flow, just calculate at the rate that is given. Then you see the answer. If the answer is negative, now you need a positive. So you reduce the rate. If the answer is positive, then you need a negative, so you increase the rate. Okay, and then you calculate the present value again of the same cash flows. Cash flows is the same. Only your discount factor has changed, hence the present value has changed. Only your discount factor has changed, hence the present value has changed. Okay, hence the present value has changed. Your discount factor has changed, hence the present value has changed. Okay, the present value has changed. If your discount factor has changed, hence the present value has changed. That's it, and you got your 12% here, and you got your 12% over here. That's it, done, finished. Okay, you just apply this in the formula, and you will then compare it with the cost of borrowing. In this question, it's at 12%, and if it is greater than the cost of borrowing, then you can go for it. If not, don't go for it. That is the first sum. Moving on now, we have one for MIRR as well. Let's do one sum for MIRR perspective. So the project, looking from the point of MIRR here. Here, when we look into it, the project with the following cash flows under consideration. So you have the project cash flows. So you have 20,000 and 8, 12, 4, and 2. So you take the outflow and the inflow. So first you take the present value of the inflow. So you have the present value here, and then you have the first. You just bifurcated between inflow and outflow. In the MIR method, I told you inflow is at a different rate, outflow is at different rate. Okay, so you did it at this. One is the reinvestment rate. Just first bifurcating the cash flows here differently. 20,000, and then you have your other cash flows here. This is done. So now what you look is cost of capital is 8%. Calculate the MIRR. So what you've done, so you've taken PVR, PVI, right? So you take the present value of all the present value of all the inflows here, and then you have your present value of the outflow, which was 20K. So you got the difference in present values, and you've got a different present value over here. So you're keeping the present value different and the outflow different. So let's look into this, how they've gone about that. It will give you a different MIR. It will give you a different rate. So for 20,000, it's at time 0. So they've kept it as it is, 20,000. Inflow present value of this Okay, so we'll just apply the present value rate here. So we'll apply the 8% over here and get the present value here. So what we will do, we'll take 8,000 present value at time 1, 12, at 4, 2. So we just take the present value of all of this. So where we'll get the present value in the present value table at 8% for 1 year, 8% for 2 year, 8% for 3 year, 8% for 4 year. So we discount everything. And then when you discount everything and you bring it to time 0, you will see you'll get 22,340. When we bring it to time 0, we get 22,340. Okay, so that is about PVI, PVR, PVI and PVR. It's about PVI and PVR. So once you've got that, 1 plus IMRRR is equal to 1 plus RE. Okay, into PVR by PVI, 1 by N. So again, 8% is already given, 1 plus RE, 8% is already given, divided by the PV of R. The PV of R we have over here. Then we have PV of I. PV of I also we have over here. And 1 by N. So the duration, you can see, of the project over here is for 4 years. So you do 1 by 4, and then the final answer you will get is 11% over here, right? So you get 1.1103. So what you do is you take it as the final answer. 1 plus MIRR is this. So MIRR, you bring it this side. So 1 you will have to subtract. So you'll get 11.03%. Okay, so you calculated the inflows at 8% and just the present value of the inflows. You didn't net it. You just calculate the present value of inflows and you remembered the formula. What was the formula? 1 plus MIRR is equal to 1 plus RE, which is the RE is the rate given in the question, which is your cost of capital, into the present value and the present value. There are two present values, right? One is the present value you took of the initial investment and the present value of all the future money that you're going to get, right? So PVR, PVI, and then you do 1 plus N and you will get the final answer of your MIRR. Last me, you will bring it over here. You bring the 1 over here, so you get your MIRR, final answer. Okay, so that is about this. But the decision rule is if your MIRR is greater than cost of capital, the project is acceptable. So in this case, your MIRR is greater than the cost of capital, hence the project is acceptable. If your MIR is greater than the cost of capital, this your MIR is greater than the cost of capital. Your MIR is 11, cost of capital is 8. So you can go for the project. So all you have to do is just keep in mind the formula. And your TYU 4 is based on this, TYU 3 is based on this. So as you revise the topic, simultaneously revise these TYUs immediately as you revise them. There will be more wholesome revision of that. Your TYU is based on interpolation. Your TYU 3 is on this, and your TYU 4 is on this. Okay, and the decision rule is also important. I'll just write it. Decision rule is if your MIRR is greater than your cost of capital, then you can accept the project. Okay, following Sri, is it clear? Okay, if your MIRR is greater than your cost of capital, then you can accept the project. Right? You just take a present value of your the one common mistake here is just the formula. Right? You have to just make sure that you remember the formula, be present value of your return phase and present value of your initial investment phase. So you take your return by investment, R by N. Okay, R by N. So always you take the return on top, investment in the bottom. Okay. The present value of your return phase versus present value of your investment phase. So that is your PVR, PVI. And over the time duration of that, 1 plus RE and minus the 1. So you'll get the MIRR. This is the formula. We just have a regular revision of this. You'll get a good understanding about the formula. So that is about this. Now let's look into discounted payback. That is done. Now let's look into the alternative way. You can do all this, but I think stick to the formula is good to go. Okay, so this we don't have a TYU on this year. We just have the theory. Okay, so we'll just go to the theory, quickly get done with discounted payback, then we'll get into duration. So looking into the discounted payback here, let's make sense of this. What is happening in the discounted payback? Very clear perspective. What are we really understanding? Discounted payback. So when we talk about the discounted payback, it basically uses discounted cash flows, right? The difference from the payback period is that discounted uses the cash flows. Discounted payback uses the discounted payback. Uses discounted cash flows. Discounted payback uses discounted cash flows. Discounted payback uses discounted cash flows instead of nominal cash flows. It uses discounted cash flows. And recovery period, it measures how long it takes for your business to recover the money. How long will it take for your business to recover the money? It's a great measure of liquidity and it ignores the cash flow after the payback. That's a big limitation of this. And it's easy to understand and communicate, right? So a very generic discussion over here. They've not paid much emphasis on this. All this is done in FM, but they have just given a reference of this, not even put an TYU on this, to be honest. So very highly unlikely to get it directly as a standalone on AFM. Right? So it uses discounted cash flows, not your normal cash flows. Okay, not your normal cash flows. So let me put it as normal cash flows here. It does not use your normal cash flows. Okay, you have to just discount your cash flows and then you use the present value of those cash flows. You don't use your normal cash flows. And recovery period, it measures how long does it takes for you to recover your initial investment. It's a liquidity measure, very good liquidity measure. Limitation, it ignores the cash flows after payback. It ignores your cash flow after payback. Simple technique, easy to understand and communicate. Easy to understand and easy to communicate. Easy to understand, easy to communicate. Easy to understand, easy to communicate. So nothing difficult on this. Quickly move on to the Macaulay and modified duration. Okay, let's look into Macaulay and modified duration. The modified Macaulay duration is basically the weighted average time to receive all the cash flows. It's the weighted average of the time to receive all the cash flows. Modified duration measures the bond sensitivity to interest rate. If your interest rate changes, how much does the price of your bond change? It measures your sensitivity, how sensitive you are. Next, interest rate risk helps manage risk if the rates change. It helps to manage risk if the rates change. It helps to manage risk if the rates change. Helps to manage risk if the rates change. Bond analysis and risk management. Bond analysis widely used in bond portfolio management. It's widely used in bond portfolio management. It's widely used in bonds portfolio management. Risk management, it matches your asset and liability durations. Risk management, it matches your asset and liability durations. Risk management, it matches your asset and liability durations. What is risk management? It matches your assets and liability durations. Macaulay duration, it measures the weighted average timing of cash flows. Macaulay duration measures the weighted average timing of cash flows. Modified duration, it measures your bond price sensitivity to interest rate. It measures the bond price sensitivity to interest rate. Interest rate risk help investors manage the interest rate exposure. It helps investors to manage the interest rate exposure. Bond analysis, widely used in bond portfolio management. It's widely used in bond portfolio management. Risk management, it matches the asset and liability durations. Risk management, it matches the asset and liability durations. Okay. So first we look into it used to match the assets and liabilities. What you do here is you match the assets and liabilities. Whatever assets you have, whatever liability you have. Bond analysis basically, or risk management is mainly used in bond portfolio management. If you have invested in a lot of bonds, then in portfolio management you can use for bond analysis. You can use these module durations. Interest rate risk. It helps the investors manage the interest rate risk. The main use of these durations is that it helps the investors to manage the interest rate exposure. It is widely used in bond portfolio management. It helps in risk management. It matches the assets and liability durations. And Macaulay duration measures the weighted average timing of cash flows and the measures the bond price sensitivity to interest rates. Well, calculation is easy, just you should know that where is it used. And so it's basically used in interest rate risk. It's used in bond analysis. It's used in risk management. So in these three are the uses of duration. Yeah, these three are the uses of duration. These three are the uses of duration. These three are the uses of duration. Right? These are the uses of duration. These three are the uses of duration. Okay, these three are the uses of duration. Uses of duration. Right? These three use duration. These are the definition of the two durations. These are the definitions of the two durations. So let's quickly look into this. These are the definitions of the two durations. I think we have a sum on this. Okay, so we'll look into how to go about the sum on this. Do we have one? We have an illustration. We have TYU5. So let's look into this. So you have to calculate the discounted payback and the Macaulay duration. All they're asking is the discounted payback and the Macaulay duration. Okay, so let's calculate the discounted payback and the Macaulay duration. So when you look here, you have the net cash flows here. So as you know, in discount, you need discounted cash flows. You can't use normal cash flows. You can't use net cash flows. You need discounted cash flows. You have to first discount the cash flows. Right. So you can't use normal or net cash flows. You need discounted cash flows. So discount at 10%. So you've discounted the cash flows. You got the present value of the cash flows. Now in the payback period, you take 127. 127 is your cumulative. Then next year you earn 33.6. So 33.6 you remove from this. You have still how much to earn? 93.4. Next year's cash flow you remove from this. How much still you have to earn? 50. Next year you're about to get 50. You earn 57, but you need only 50 to break even. So you do 50 divided by 57.1 and you'll get your modified duration. So if you see here, 50 divided by 57.1 and you'll get your 2.9 years. And within 2.9 years, you'll get your initial investment back. Within 2.9 years, you'll get your initial investment back. So first what you did, you wrote down all the present value cash flows, right? For all the years, you just wrote down the cash flows. So here you can see, first of all, you just wrote down all the cash flows, easy. Then you did a cumulative cash flows. Then you did what? You did cumulative cash flows. You did what? You did cumulative cash flows here. So you see, you take 127, 33 minus 127 minus 33.6, you get 93.4. 93.4, then you earn 43, but you had to recover 93. How much you had to recover? 50. Next year you earned 57, but you had only to recover 50. So you can't take the entire year. That's why 2.9 years. 2 years, so obviously you will need to recover the money minimum in the second to third year. In between, you got your remaining money. So 2 years plus 50.4 by 57.1 is 2.9 years. That is your 2.9 years. 50.4 by 57.1, that is your 2.9 years. 50.4 divided by 57.1, that is your 2.9 years. That is your 2.9 years. So discounted payback period is 2.9 years. Easy. 2.9 years. You took the cash flows, you took the present value of the cash flows, you got the cumulative cash flows, and then you got your 2 years, 2.9 years. Okay, you got your 2.9 years. Easy, done, finished. 2.9 is now coming to duration. Duration is very easy. What you have to do is just multiply the present value with the year, right? Multiply the present value. You took all the present value first of all. Just multiply it with the year. First of all, you take all the present values. For both, you need the present values. You calculate the present value. Done, same as it is. Then just multiply it with the year, right? Present value 43, right? You do into 2. 57.1 into 3. 47.1 into 4. 27.3 into 5. 16.4 into 5. So you just multiply here, this thing, the present value into the time, present value into year, present value into year, present value into year, right? So what you do is you take the present value into year. Okay, you take the present value into year, present value into year, present value into year, and then what you do after this, you just divide the two. You just take one under the other and you divide the two. You take your present value that you have got after multiplication on top, right? So after multiplication, present value in year, whatever you get on top, you add all of them. Here, see, we have added all of them, divided by, you add up all the, just the present values. Just add up all the present values. Just add up all the present values and you will go get your duration, 3.2 years. What does this 3.2 years means? Macaulay duration. What does this 3.2 years mean? Right? And basically, when you stand for what does this 3.2 years, if you were to ask me, it measures the weighted average timing of your cash flows, right? In simplistic sense, it measures the weighted average timing of your cash flows. It measures the weighted timing average of your cash flows, right? Your weighted average time to receive your cash back, right? On an average, how much time it will take for you to receive your cash back, right? Of return of your initial investment. Let me write it more clearly. Return of your cash flow that you had incurred, right? Means the weighted average time of return. So on an average, how much time you will take, right? Of return of your cash flow. On an average, how much time you will take? At weighted average time to receive your cash flows, right? Weighted average time to receive your cash flows. That's it. Weighted average time to receive your cash flows. So just take the formula here. Weighted average time to receive your cash flow. What is your weighted average time to receive your cash flows? Weighted average time. Sum of present value into year is divided by the present sum of the present value of these return cash flows. That's it. Right? This is your formula to calculate the Macaulay duration. Okay. This is your formula for the Macaulay duration. Okay. Let's see if they've given the modified duration formula as well. We will look into the modified duration formula as well. Okay. So it is your modified duration is Macaulay duration answer divided by 1 plus cost of capital. Divided by 1 plus cost of capital. Very easy, simple. You have to just main calculation is Macaulay duration. And then modified is very easy after that. You just take the Macaulay divided by 1 plus cost of capital. You just take Macaulay, and in this case only we have done one sum there only you can calculate it for Macaulay as well. If you look here and the sum that we have done, you take 3.2 divided by 1.01. Right, 1.01. 3.2 divided by 1.01. You take your Macaulay divided by 1 plus cost of capital. So 10. So 1 plus 0.1. 1.0, 1.1. So 3.2 divided by 1.1. You'll get your modified duration. Okay. So that is how we'll look into this and we'll keep it at this. To close this chapter tomorrow, I think we'll be able to.